Thanks for joining us today on Market Call. I'm Morella Fernandez. We have Andrew Pink on the show, portfolio manager at LDIC. He's going to take your questions on Canadian mid and large caps. Call us toll free, 1-855-326-6266. You can send an email question as well, marketcall@bnnbloomberg.ca. Thanks for coming in.
Thanks for having me.
We are in the middle of earnings season. A few of the big techs reporting only yesterday. What's your take so far on how it's going?
I mean, so far so good. We had a very strong Q2, and we're early stages, especially in Canada here for Q3, but earnings are coming in pretty strong here. And I saw Google way up this morning. So the big tech giants some are hit and miss, but I think Meta was down.
Meta was down about 11, yes.
Yeah, so a little hit or miss there. As I say, we're early innings here for Q3 in Canada, but Q2 was very, very strong. So we beat by about 6% in Q2. Earnings growth about a little over 8.5% in Q2. And we think there's some follow-on going to happen. We'll see it in Q3 results.
Okay, let's talk about trade as well. We have the Chinese leader and Donald Trump agreeing to make some cutbacks, at least in the tension. So Donald Trump wants to reduce the rate on Chinese tariffs.
Yes.
Canada and the U.S. aren't on the best of terms right now. Is that, you think, still waiting on or weighing down the investor side of things?
I think to an extent, whenever you have a lack of visibility in the markets, it weighs on markets, it weighs on sentiment, and investors are fearful, and that can hurt markets. But I do think that it's sort of a little fatigue here. I mean, we've seen so much of this activity since Trump started all this noise. It sounds like Carney and Trump were speaking at this dinner, and it sounds like things are improving there. And the news with China is obviously good. A big, long deferral is always good. And I think that's what Trump wants, is ultimately a resolution to this. So
I do want to get you on gold as well. Where do you see us going for gold? It's tracked back a little bit over the past couple of weeks, still at about $4,000 an ounce. Do you think it'll continue its run?
You know what? It got a little obviously ahead of itself. I think we're only back to where we were a couple of weeks ago at this stage. I think it's just through 4,000. If I look, yeah, just through 4,000. I think we got a peak of 4,400. I think this is central banks buying. I think they're selling treasuries and they're looking for a place to park capital, and gold is one of those places. And gold's such a small market compared to how big the U.S. Treasury market is. So that demand, I think, hard to know when that's going to dry up, but I don't think anytime soon. So I think there's probably some tailwinds left here in the price of gold, but the companies themselves do very well in a range of 3,000 to 4,000, extremely well, because they're all in sustaining costs are somewhere around $1,500, $1,600. Margins are extremely wide at even 3,500. So we think it's a good space to be. We're not at market weight. We'd be about 6% weight in gold right now, and some strong, production companies and a little bit of exploration, but and a royalty company. So, yeah, we're there, and I think it's sustainable.
Okay, we will take a quick break. We'll line up some phone calls for Andrew Pink of LDIC. He's taking your questions on Canadian mid and large caps. Back in a moment. Welcome back. Thanks for joining us here on Market Call. We will start with an email today from Tim. He says, what is the forward prospect for Cenovus? We turn that question over to Andrew. Cenovus, of course, has its hands in a number of things, but what's your forward look on Cenovus at this point?
Yeah, it's a large integrated energy player in Canada, and we like it a lot. We own it. They came through some turbulence, so they had some spending to do to upgrade some of their refineries. They did that. They ramped up their debt in the meantime, but they've since reduced their debt to a nice, reasonable level.
Okay.
Now they're in the process of potentially buying MEG. And,
yes.
And actually, I noted that there was a decision that was supposed to come out from MEG shareholders on that deal. They've sweetened
delayed
the deal,
it again.
And they just delayed it again. I just see the headline now. So we'll see how that goes. It's Cenovus continues to sort of up the ante here and bid more and provide more favorable terms to buy the company, I think it would be a good deal.
Yeah, what's your opinion?
Yeah,
on
I think
this?
it would ultimately be a good deal. Obviously, it weighs on Cenovus because they would have to finance it. When they finance it, a portion of that would obviously be in equity, and so that weighs on the share price in the medium term, or in the short term. But I think in the long term, I think this is a great holding. We're willing to stick it out and see if they actually make this acquisition. It would, with synergies, I think it would be a great deal for them.
Okay, let's move to the phone lines then. Dimitri's on the line. He's in Markham, Ontario. Hi, Dimitri.
Hi, how are you today?
Good, thank you.
I'd like to ask, please, about Keyera Corp. What you think of the company, and is it good for either a medium or a long-term hold, please? Thank you.
Okay, Keyera natural gas liquids. We expect natural gas to get a boost in the coming years, but so far it's kind of been depressed.
Yeah, it has been depressed. There's obviously a huge supply in gas. We do like it as a transition energy. We like the midstreams, and we do like Keyera. We own Keyera. Big yield, over 5% yield. It operates in a number of different areas, but transporting, storage, blending, and all of those things. And yeah, we do like the company. I think they historically had gotten a little bit offside in their marketing. So that's where when they buy and they sell these products through the carbon chain. They've got a handle on that now. So we like it. I think it's a stronger company. I would be buying it on this dip.
Okay, let's move on to Reg then, who's calling from Winnipeg today. Hi, Reg.
Oh, yeah. Good morning. Thanks for taking my call. So my question for your guest today is on Manulife Financial. I phone in every once in a while on Manulife because the life codes don't get a lot of airtime on BNN. Anyways, my question is this. So when you line up the fundamentals on Manulife versus the banks or other insurance companies, you find that it has very good fundamentals, very good dividend, biggest footprint out of insurers in Asia. Assuming in 2 weeks from now they report and they beat the analysts' expectations, what's your guest's opinion on this? Because it has very strange trading activity. It seems like every day it opens, it goes straight down. The last 20 minutes of the trading day goes straight down. And on a fundamental basis, this should easily be over $50. It just doesn't make sense. Your opinion. Thank you.
Okay, thank you for the question. Manulife Financial currently trading at 45, 44, a little up on the day, but 151 up over 5 years. What's your take on the space?
Yeah, we like the space. We also like the banks as well, but we own Manulife in a smaller way. We own Sun Life in a bigger way. I agree with you. I think if I look at the valuations, it's trading at 1.8 times book, so it's not cheap, but by historical standards, it has historically over the last 5 years traded at 1.2 times. So it's a little bit more expensive. They do have assets like management assets, so when markets are up, things should be good for Manulife. So I think they have a good chance of putting up a very strong quarter. And I agree. I think the stock can continue to move higher, but be aware that it's not a cheap stock, and you're not buying value. You're buying a little bit more momentum by its historical standards, and not necessarily relative to peers, because Sun Life trades at a higher multiple. But I think you're right. I think they could put up a very good quarter, and it can continue this momentum.
Okay, let's get to an email from Rob then. Rob writes, I'm trying to understand why Constellation Software stock is dropping. I have a position. Should I hold or sell, or is it a buying opportunity? So a couple of different things happening with Constellation. Leadership change, I believe, was part of that. And then I guess there are questions about the business model in the time of AI.
Yeah, I think the sustainability of this business model, they're a big acquirer. Software stocks in general have come off. So to the extent they buy that type of company, so there's a lot of change. And again, we look at valuation. My colleague did a deeper dive on this. I didn't do the work, but they came back and assessed that it was a little bit overvalued, and that they may have a harder time in AI, as you point out. So I think this rollover, I'd be waiting for it to find a level. I wouldn't be buying it here, but if you look at it, I think this is a three-year chart. But you look at it on the 5 year, yeah, you can see that there's a lot of downside to get into sort of some stability there at 2,000 or 3,000, maybe even 2,000.
So you would wait for it to go a little sideways?
I would definitely wait for it to go a little sideways, look for a couple more quarters and see how they're doing, and
then make a decision.
Yeah, I would say so.
Okay.
Yeah.
All right, we are going to take a quick break. Andrew Pink with us today, LDIC, taking your question on Canadian mid and large caps. Here's how to reach us. We're back in a moment. Welcome back. Let's go to an email from Al. He says, Intact Insurance has had a big pullback. What are your thoughts? Is this an opportunity? We will pull up the chart for Intact and have a look at that. Any obvious reason for a pullback in Intact?
Yeah, I would say stretch valuation. We're always looking at valuation. This got to a point where it was trading over 3 times book, so that's excessively valued. There's another sense that the market is just not as interested in these large cap stable businesses. And so you've seen a lot of money flow into growth and momentum, and you've seen money come out of these stocks that are safe havens.
Yes.
And so I think that was a part of it. And then there's, I'm hearing about price competition in P&C. So I think what's happening is that various companies are trying to gain market share. So they reset their policy pricing to try and gain share. And that can really hurt a business as well. So I think, that's happened in the telcos for many years. And I think maybe that dynamic is playing out in a little bit in the P&C insurance.
Do they do that very often?
I don't believe so. I don't think that happens. There may be a little more collusion there than what's happening in the telcos. But it seems to be a dynamic that's happening now and maybe hasn't happened that often in the past.
Okay. Let's go to the phone lines, and we have Mike on the line in Toronto. Hi, Mike.
Hi, I'd like to ask about Storage Vault. It's kind of traded sideways a bit now after a nice run-up slowly after COVID. Do you think it's a good stock here? It pays a dividend, but very small.
Okay, thank you for the question. Storage Vault. Storage units have been pretty big.
Yes.
They seem to be sprouting up at every corner.
They do.
But how are they doing now, sort of in that sector, or is there a story specific to Storage Vault Canada?
It is specific. I ran into the CEO recently, and in fact, there is a lunch happening right now that I was going to be at when I'm here. But so I know the story fairly well. We came through a period where there was a bit of a slowdown after COVID. Things changed. This business is usually very seasonal, that it grows at between 4% and 6%, that they lease up through the end of the summer, and then that stays stable, and then people move out at the end, at the beginning of in the spring. And that cycle keeps happening. They got a little bit off balance on that through COVID. Now they're back on track. I think this year the leasing rates are a little bit lower. They got to a peak occupancy of, I think, low 90s, high 80s, where they normally get to mid 90s. So that has happened. But you say that this is a little bit of a different story in Canada. We don't have as much density in Canada for storage spaces as there is in the States. There was another thing where we had an IPO in the space, so that caused a little friction here. I think all of that is behind us now, and I think now we're moving back into this sort of better routine for them. And so this is a name that we look at very closely. We don't own it right now, but I have been looking at it very closely and would buy it back. I think it's a really unique business. There's a lot to like about it. These low lease durations are very good for finding market rents, because people move in and out every, I think the average is 3 months to 6 months, but maybe even a year. But as you recycle that, you can get price discovery, and that can mean that you can very quickly reset to market rents.
Interesting.
So I like that about it.
All right. Let's get to David in Barrie, Ontario. He's got a question today. Hi, David.
Hello, yes, good afternoon. Just want to ask the gentleman about Shopify. I have a lot of it. I just want to know if to keep it or sell it. Thank you very much and have a nice weekend.
Okay, thanks for the question. Let's pull up the Shopify chart. Shopify tends to be pretty volatile and moves up sort of in spurts, but let's have a look at where they stand today. Clearly, it's a company that has a business model that is working. where they
Yes.
farm out what they have to smaller businesses and some larger businesses now too, as a model, like a platform for them. It's at 175 today.
Yeah.
And the high was to 175 to 179 was the high, which was just a couple of days ago. So what do you think about Shopify? Is it something worth holding on to?
So I like the story. I think the total addressable market that they have is massive. It's a great Canadian story. And I'm not alone in thinking that. And it trades at a huge multiple as a result. And you mentioned the volatility. You can see that it traded from back in 2022 from kind of 200 all the way back down to 60, 50. So you have to be able to withstand that kind of volatility. It's not suitable, I don't think, for a significant part of your portfolio, but it is very unique. It's a reason that it's trading at this multiple. It's unique. They've got a huge addressable market, and they've got a mousetrap that works better than a lot of others. And so I think the growth trajectory is very good, but I would just caution that you got to be able to weather the volatility. So
Why is it such a volatile stock? Any particular reason for
well,
that?
it trades at 100 times earnings, so that it can, to justify that, you got to look out at future cash flows way out in the future, and then discount those back to present value.
So it's just wobbly because the future look is so far down the road.
Any fluctuation in your estimate of how this company can do way out down the road is going to make a big difference to the valuation today.
Okay. Let's go to the phone line to Elliot on the line in Hamilton, Ontario. Hi, Elliot.
Good afternoon. Against the backdrop of a continuing freight recession, Descartes Systems is down about 25%. However, I would have thought with this tariff turmoil, this would have been their bailiwick. They are in the business of expediting and sorting out all the paperwork for cross-border product transportation. I thought this would be the golden years for Descartes. What's wrong with my analysis? Thank you.
Thank you for the question. Descartes does software for supply management, essentially.
Yes.
What do you see, if you do see any fault in his theory here?
So I had the exact same theory, and I believe that this company had done very well for a long time. We were big owners of this company. We trimmed it when it got above about 150, 160, and we more recently sold it in the kind of $140 level. And the reason is, I had a lunch with the CFO, and I asked him specifically, what is the impact of AI going to be on your company? And the very obvious answer is that AI can do a lot of what they sell, their product. So, and over, as it's generative AI. So over the long run, I think that product is going to improve, and that's going to impede their ability to sell their product into their clients. So really, I think it's as simple as that there's a competing product out there right now that's free. And so that's an issue. They've told me that they're going to work with AI and try to improve their product that way, but I do see it as a bit of a threat going forward. So I think that's and your description is exactly perfect, which is this should be the perfect time for Descartes to excel. And the fact that it's not, and the fact that it's going down, leads me to believe that others have drawn the same conclusion as me. That this is a business that's
they haven't
quite
figured out
threatened.
how to use AI to help them get better.
True. And I should also say that, this is a software company, and it's not dissimilar to the other software companies in the space. They're all feeling the same pain. So you can overlay this with any of the other software companies, and the chart looks pretty similar.
Got it. All right, we are going to take a quick break. We will be back with past picks from Andrew in just a moment. Stay tuned. Welcome back. Time now for past picks from Andrew. These are from April 30th of this year. We were just talking about the fact that Trump had Liberation Day in April. Everything sank down. So you're going to look great today because everything's gone up. Atkins Realis was your pick at the time, 68.27, now at 102.02. So 48% upside and total return the same. This is an engineering company sort of remade from a former shell of a company. And do you still like it? Is there sort of growth for Atkins Realis moving forward with the build-out planned in Canada?
We do really like that. And I should say the TSX in that same time frame, I think, is up about 22% or so. So it's been a nice relative outperformer. It's an engineering firm, and they've got a big component in the nuclear space. So this is the former SNC-Lavalin. I don't like to say that to people too often because they have a very terrible past.
Yes.
And this is a new company. So they've rebranded, new executive team. They're going global. Atkins was an acquisition they did in the UK. Realis is sort of the idea that they're sort of realizing a new future for themselves. It's a great company. I think it's a great company all around. I like engineering because it's asset light. They're in the global mix. They've got a good business mix. So there's a lot to like about it. And the nuclear space is really, especially with this new $80 billion deal that was announced the other day with the U.S. government and Westinghouse and Brookfield. So I think, this is a great place to be. Like the story, I think it's right around $100. And
it's 101. It was up at 105 sort of September.
Yeah, so a nice place to buy it. And nuclear seems to be the big story. So they talk about that every quarter, and that's the big growth trajectory, the big growth angle for them. And they do the refurbishments, and they have that small SMR, small modular reactor.
Yes.
Reactors. So they have expertise there.
Which is a sort of growing market. I know the U.S. is talking about building the larger nuclear reactors.
Yes.
But Ontario is looking at the small.
They are, for sure. That is definitely a growth market. It's easier to get through. It's a little bit less expensive, but it produces a lot of power. So.
Okay. Let's get to your next past pick from April then. Sienna Senior Living, SIA on the TSX. It was $16.93 at the time, and now it's up to $19.02. So 12% upside, total return 14%. This is, I would imagine, a buy it and hold it stock, considering we're getting older.
Yes.
And a lot of us are now relying sort of for our parents or other family members, some extra help and care.
Absolutely. That is the exact theme that this investment encapsulates and we get exposure to. They have long-term care as well as senior residences, so it's about an even split there. The long-term care is more regulated government, not as high margins, but the residencies is where you can get a lot of margin because you can reprice that product. There's not many senior residences being built right now. It's hard to get, it costs too much for the land and for the labor, materials. So they've got a nice portfolio. I like the stock long term. It trades a cheaper stock than Chartwell, its main competitor in Canada. And we like the company very well. And it is really on that theme that we've got an aging population. The affordability is there because our housing market is doing reasonably well. And so you think about a family or a couple or an elderly person who will sell their house and then will use those funds to, finance
into retirement home.
Yeah, finance a retirement home. So
okay, let's get to your last past pick from April, Capital Power, CPX on the TSX. At the time, it was $52.30. Now it's up to $71.09, so 37% upside, total return of 40% upside. Tell me about Capital Power. Is it stock you still hold?
Yes, we still hold Capital Power, and another great stock right in this theme of energy transitions. They have a whole bunch of renewable energy plays in the United States. They're one of the biggest supplier of power in Alberta. And it's become more newsworthy recently because data centers are looking at Alberta to set up shop there, cheaper power.
Yep.
And there's a whole dynamic going on with ASO there, and Capital Power is right at the forefront. They've got, as I say, a lot of power from their Genesee asset, and they will. It's only a matter of time in my mind before they partner up with one of these big hyperscalers who needs a lot of power, and that contract will be very interesting to see and how that benefits Capital Power.
Okay. We have to take a quick break. We will line up more phone calls for Andrew Pink, LDIC. He's taking your questions on Canadian mid and large caps. Back in a moment. Thanks for joining us on Market Call. Robert's on the line. He's in Burlington, Ontario, and he's got a question today. Hi, Robert.
Hi. I'd like to ask about Baytex Energy. I won't go into the energy requirements. You've already done that. But I think Baytex is undervalued right now, and it's a sweet takeover target for somebody. What are your thoughts on that, please? Thank you.
Okay, thank you for the question. Baytex sitting at $3.20, down a little bit on the day, down 18% over the year. Anything specific with Baytex that you know about that would pushed it down a little bit so far this year?
I don't have a lot of intelligence on what's weighed on the stock recently. I know the assets. We used to own this company a while ago, but we haven't owned it for a while. In fact, we haven't owned producers in a big way for a long time, and just had the sense that energy prices were going to be. I mean, Trump wants lower oil prices.
Yes.
Whatever that's going to take, whether it's
happen.
huge drilling,
He'll make it happen.
Whatever
yes.
that's going to take, that's what he needs. He needs gas prices to be lower. So we've kind of been out of this space a little bit. I see it's done exceptionally well over the last 5 years. It's a light U.S. light oil predominantly, I think, or at least half of the business is that. I think they've got some great assets, and M&A is going to at some point pick up. These companies are reasonably well capitalized now, so they have room to grow and room to grow through acquisition. I think production growth always makes sense for these companies. So to the extent that it's a takeover target, it's just we don't typically buy a company just on the basis of a potential takeover. It's a really difficult thing to predict the timing of, and a lot can happen in the meantime. So higher view thesis on oil, we stick to right now the midstream companies. They've got sort of better free cash flow profiles, more consistent, stable cash flow, and valuations look pretty reasonable to us.
Okay. Let's go to Debbie then in Burnaby, BC with a question. Hi, Debbie.
Hi, good morning. I'm just curious, please. I do have shares of CNQ, and I'd like to buy more, but I'd like his opinion on the stock itself.
Okay, thank you for the question. CNQ, like other oil and gas companies, but with that oil exposure, is quite down.
Yes.
I know everybody talks about it being such a reliable dividend provider, for example. Would you dip in at the price it's in today?
I mean, we own it. I should say that we own it in our growth mandates, and another manager at our shop owns the stock. So I don't cover it myself. I prefer the Cenovus, which is an integrated company. It has a little bit of upstream, a little downstream, and midstream assets. So I like it for that respect. The oil sands companies, again, I think it comes down to, where we are with energy prices. Are we likely to go sideways for the next 2 or 3 years? In my view, sideways to down is probably where the oil price goes. We've got a lot of supply. There's a lot of talk about peak oil. There's a lot of talk about, this energy transition, and I like that theme, and I think that's happening. So to the extent that continues to happen, it means that our demand on oil is lower. So I'm not caught up so much in this type of stock. I think there's other opportunities, other places to add. I don't mind it as a company, but you can see it's been traveling sideways here for quite a while.
Would you hold it for a dividend?
I don't myself. I like dividend with a dividend company with some growth on it
as well. Okay.
So yeah.
Okay, Debbie, I hope that gives you some clarity. Let's go to Amin in Thornhill, Ontario. Hi, Amin. Amin, are you there? Okay, so I think the question was about TFI International, which has also really not come back from being pushed down at the start of the year. And I remember taking a turn, they're out of Quebec, and I remember taking a turn when they said, we're going to move our headquarters to the U.S.
Yes.
And then it plummeted, the stock went down. But it hasn't really recovered. It's transportation. I know that space is down.
Yeah.
But is there anything specific for TFI?
I haven't. So to be clear, I haven't followed the stock in quite a while. We eliminated all of our companies that were exposed to tariffs, and this is obviously one of those stocks. And I think the idea of Alain to move the company down to into the U.S. was obviously related.
Yes.
And so the market obviously doesn't like that idea. I think freight rates have come down. I think volumes have come down, and there's just this ongoing sense that we're not sure what the next leg of this trade war is going to be. And so, yeah, there's a lot of moving parts there, but we don't own it. I wouldn't be buying it down here even until there's, some sense of like real clarity on what's happening with this trade war.
Okay, let's get to an email then from Porter. Do you think Couche-Tard will ever be profitable again? I'm only taking losses, is what it seems. Couche-Tard went after some 7-Eleven outlets from the Japanese owner. That was a long process that didn't work out for them. They retracted the offer in the end, and they haven't come back. And I know they grow by acquisition. So are there other acquisitions sort of on the horizon for this company? What could track them back?
There would be other acquisitions. We own a company called Parkland, which was a competitor of theirs. And it's a difficult space to be in. Again, I think it comes down to this is a very good business. They're a big global player. I like the theme a lot, but the market doesn't seem to care about these companies who are, large, that are kind of slow movers, but
they want action. People just want action.
They do. They want momentum. There's a lot of more interesting spaces to be invested. So we don't own it right now. I'd wait and see sort of how things play out. They're obviously not going to do that acquisition. There's nothing, I don't think, that huge. There's other acquisitions to be made. They used to partner with Parkland a lot to buy things just to get around the antitrust laws.
Sure.
So they would have to divest some to buy a bigger parcel. I'm not sure if that's happening anymore. We don't own Parkland either at the moment. So we've kind of moved on from that space.
Okay. We are going to take a quick break. Back with Andrew Pink of LDIC, taking your questions on Canadian mid and large caps. Here's our number. Back in a moment. Welcome back. Let's take an email from Greg. He says, please give me your outlook on Vermilion. What is your outlook for the stock over the next few months? Will it return to past highs? What are the reasons for the decline in price? A lot of questions, very specific there. Is there a reason for the decline for Vermilion?
Well, Vermilion, about quarter of, so this is a gas producer. 90% of the assets are gas, 10% are legacy oil. And I think what happens with this stock, well, I know what happens with this stock. I think 25% of its production is from Europe. And gas is a local commodity. So local situations control the price of gas. And as we all know, there's huge geopolitical issues in and around Europe that will, cause the price of gas to fluctuate more meaningfully than it does here in Canada and in North America. So that's one thing you have to be very careful of is that the gas prices can come way up and really benefit a quarter for Vermilion, 1 quarter, and you kind of lose touch with what's happening, and gas can come way down the next. So we've steered clear of it a little bit on that basis. It's hard to know, to keep in mind a trend that's going to happen. We like Tourmaline. Tourmaline's a big Canadian player, and they've got access to 3 or 4 different markets in North America, so they can sell into either one of those or any one of those, and control prices that way. So I think that's probably why you're seeing more volatility in something like a Vermilion than you would probably in a Tourmaline.
Okay, let's get to an email then from Ian. What does Andrew think about Brookfield Asset Management? Brookfield Asset Management, part of the group that is benefiting from a deal with Washington. We spoke about with Cameco to build these nuclear reactors in the U.S. $80 billion worth is the number that's been thrown out. They got a boost from that. And then generally, if you can give me an idea on Brookfield. Yeah,
Brookfield's a great, very well-run company. They've got all their divisions. We've been in and out. We own Brookfield Asset Management in our growth mandates. We like the company a lot. They have huge fundraising that they do every year. And then those assets get funneled down into the various categories and gets invested in key infrastructure, massive projects. And this new $80 billion project that's partnered with Westinghouse, which they own, and then the government, the U.S. government, is massive. It's a massive deal. It's got a huge runway. They have the capital, and so We like the story a lot. It's a complicated one because there's a lot of fees on fees on fees, and and all the various divisions, and it's hard to keep track of everything that's going on at the company. But definitely like the company. It's sort of a one of a kind. There's a lot of smaller companies that want to be Brookfields, but there is really only one Brookfield in Canada, so it's a nice place to invest.
Okay, let's go to an email from Sam. Of all the Canadian banks, so what does Andrew think about buying TD Bank? TD's recovered from its woes of last year somewhat, but is there more room to grow for TD? We'll pull up that chart in a moment. I think it's over $100. I can't remember where it landed. I haven't looked at it in a little while, but I'll take a look now. Is there room for growth in TD, even though their assets in the U.S. are capped?
Yes. So I've always liked TD. TD was our biggest holding going into, and so just as a reminder, this company was faced some anti-money laundering challenges, as I think everyone knows, and we went through a situation where they were fined by the U.S. Attorney General. It was a $3.1 billion US fine that hit the company. This really knocked the wind out of the sails. The other banks continued to rally and move higher, and TD stalled for a period of time. They've since put together an excellent team to address this. They've been very forthright with investors and said, here's what we have to do. This is the money we have to spend to get our systems aligned with, with the regulators and all these challenges. So they've really done a great job in addressing that. So they will continue to do that. I think it's still undervalued, still trades at a discount to the banks, and yet it's a premium bank. This used to trade at a big premium with Royal Bank. I still think that a lot of the same attributes, I know a lot of the same attributes are there. They still run very high quality divisions within the bank. And so we still like it a lot. I think it can still trade at a premium. So even though you've seen it rally as much as it has year to date, it's still trailing where I think it should be. So we're still an owner, still a buyer, and I'm not selling it in the stock.
Okay, good to know. Let's get to an email from Corey. I've had my eye on Loblaw for a while now. Should I buy? Loblaw took a hit the other day. I'm wondering where you are on Staples these days.
We're nowhere on Staples right now, and we missed a big run because they did very well. We're still not there. Loblaw's, with all of the noise around tariffs and so forth, they're also involved, and I think a lot of what was happening, and I believe that run that we're seeing from March through to May is a little bit of that was, as the tariffs hit, they're not necessarily charged right away, but they can reflect that in their pricing. So their margins had widened out a little bit as a result. So maybe the distributors and the product suppliers are coming in and subsidizing some of that. And the story to consumers is our prices are going up because of inflation, because of tariffs. So I think a little bit of that is some inflation that they priced in but are not necessarily paying for. And maybe some of that is working its way out now. So we're still going to stay away from the staples in the meantime. As I said before, the big staple blue chip companies are less loved today in the market because these momentum stocks are doing so well.
Okay. Let's get to Kevin then. He says, what are your thoughts on AQN for a 2-year hold? This is Algonquin Power sitting at 784. So up close to 17% on the year. Another sort of energy space question. What are your thoughts?
Algonquin used to be a large holding for us, our largest IPP, so independent power producer. They got involved at some point in a company in Spain, and it was supposed to be a marketing angle where this company would, allow them to invest in opportunities in Europe, in Spain and in Europe. And that didn't work out so well. And so they've come through a long way. I think they're 2 management teams after since I've been invested. And I love the investment theme. I think, maybe looking at the chart here, might be worth a two-year hold. You're going to get paid a dividend and possibly get back to kind of in line with where the rest of the group is trading. We like Northland Power, and I like Capital Power a little bit better than Algonquin.
Okay. We are going to leave it there for questions today, but don't go away. Andrew has new top picks. He'll share them when we come back. Join us tomorrow on Market Call. Brianne Gardner will be with us on the show. She's Senior Wealth Manager at Velocity Investment Partners, Raymond James. She'll take your questions on Canadian and U.S. large caps. Let's get to new top picks from Andrew. We'll start with Exchange Income Corp, EIF, on the TSX. This is a company that does aerial surveillance. I think they also build small planes. They've got a kind of a range of things that they do.
They do. They're an acquirer. We've owned this for a long time, and they acquire businesses in two verticals. So the aviation and aerospace is one, manufacturing is another. But all the companies, there's a theme here, and the theme is that these are all essential services. So when you talk about, they've got routes that aircraft routes or airplane routes that fly into northern
Arctic,
Canada.
yes.
And this is the only way in and out and also to get food in there and supplies and all the rest, mail, all the rest. So this is a very required essential service, contracted revenue for them. Surveillance, you mentioned, so maritime surveillance, they're selling globally. They sell that to governments, also required, as you can imagine. They've just got into a business line on their manufacturing side, which is mats, so matting for, think about selling into utilities or into energy service, where these people have to go into remote locations, and sometimes it's very difficult to get in and out. They have to lay down a road, a temporary road, access road, and that's required actually as an environmental regulation, that they need to do this to protect the ecology and the environment. And so this is a great business as well. So all of these businesses are combined to, it's essential. So it makes them a little bit more resilient when economic condition changes. And I would say one thing is that, institutional investors used to own about 30% of the stock, dipped down to that was in 2014, and it dipped down below 10%. I'm now finding that more institutions are warming up to the stock again. We're up to about 13, 14% ownership by institutions. That's a big thing because it drives demand for these companies. And so, the business is doing very well. They've got an amazing 20-year track record of doing annual returns north of 20%, which is unbelievable. So that's 3 times the TSX. So really good company, love management team, and I like the business altogether.
Okay, let's get to your next pick, which is Granite Real Estate Investment Trust. So GRT-U. Real estate has been a harder push this year.
Yeah.
What do you like about Granite?
So Granite is an industrial real estate company. The evolution is that Magna International basically sold its real estate in a lease buyback, and the company was started. So it was 100% Magna manufacturing facilities originally.
Okay.
That number's dropped all the way down to 26%. So now 26% of its net operating income comes from Magna. So there's a couple of things that 50+% of their business is U.S. based, and we came through a period since the trade war initiated where companies were less willing to sign leases, long-term leases. They didn't know what was going on.
Sure.
That I think we've gotten to an inflection point there. So we saw vacancies tick higher. So we got to about 5.5%, and we've seen that pace slow down. So we started to see a cap. So I think vacancies in industrial space have started to cap out, and now we're going to be on the other side of that. The company has reinforced that thought and has increased their guidance for the rest of this year. So we're starting to see leasing activity pick up. That improves pricing, that improves their margin. So this business is very good. I think the overhang of also Magna being 26% of their business has also started to clear, because investors are now, we've seen Magna sign very long-term leases now, 11-year term leases. I think Magna's come to a realization that they're not going to be moving their manufacturing facilities. They're signing longer-term contracts. They're okay with kind of the evolution of however this ends up. So I think Granite's in a great place, and you can buy it at a little bit of a depressed price. It trades at about a 20% discount to NAV.
Okay, let's get to your next topic, WSP Global, WSP on the TSX, which is another engineering company. We talked about Atkins-Realis.
Yeah.
What does WSP do, or do they have a niche?
They do have a niche. So they're a huge global engineering firm, so not dissimilar to Atkins-Realis. We've owned WSP for a lot longer. 73,000 employees. They work in OECD countries, so very stable jurisdictions. They've got expertise around the world. So engineering expertise in water, environmental service, transportation, and power. So all of the, where the globe needs to invest is where their expertise is. So it's a huge thing for them. They've done extremely well over the last 5 years. So delivering, earnings CAGR of 20%. It's pretty unbelievable. They've got a strategic plan as well. So the strategic plan goes out till 2027, and we think they can hit it. So really like the stock.
All right, WSP it is. Andrew, I got to leave it there. I'm out of time. Thank you for your time. And thanks for joining us today on Market Call. We'll see you back here again tomorrow.